Welcome back. And in today's episode, we're going to talk about Sofi and what the CEO thinks about the current state of their business and why I think this can be one of the biggest banks in the world. First, let's talk about the CEO, Anthony Noto. Anthony Noto joined the company as CEO in 2018 and was previously a managing director at Goldman Sachs, the CFO of the National Football League, and the COO of Twitter. So he clearly has a wide variety of experience in many different industries. And the vision that Anthony Noto has for Sofi is to make them the AWS of fintech, while also helping people get their money right by offering a full suite of products, whether that be banking, credit cards, investing, and lending. Now, what does he mean when he says he wants Sofi to be the next AWS of fintech? Well, with their two most recent acquisitions, he thinks those will be able to expand their B2B offerings and generate reoccurring revenue from selling the systems that financial institutions use. For example, one of those acquisitions was the company Galileo, and this is a payment processing company, which allows their customers to build apps on top of their custom APIs. This allows new fintech companies to create checkings and savings accounts with all the features that come with it, whether that be 2-day early pay, direct deposit, and the ability to earn interest. Now, their second acquisition that they made was Technisys. And Technisys has a somewhat similar approach to what Galileo is trying to do, where they're building financial infrastructure in the cloud as well as offering APIs that people can build their apps upon. Now, not only does Sofi Technologies plan to be a huge part of the business-to-business fintech market, but they also offer great commercial banking services like checking accounts, savings accounts, credit cards, investment products, and loans. For example, if you sign up right now and start banking with Sofi, you can earn up to 2.5% interest on your money in your checkings and savings accounts. Now, 2.5% may not seem like a lot, but compared to other big banks like Chase and Wells Fargo, which offer 0.01% and 0.02%, it is over 125 times better than those bigger banks. Now, Sofi has a huge competitive advantage in this space because as a younger person who doesn't necessarily care about in-person branches, you can get everything you need within the app and online within an instant. And with younger generations continuing to adopt technology, we will see an increased demand in online banking because they're able to offer far better products because they have far less overhead. Sofi also offers a credit card which gives you 2% cash back with no foreign transaction fees, identity theft protection, cell phone protection, and no annual fee, while most other cards give up to 1.5% cash back with random categories giving you 3 or 5% cash back. As well as offering a credit card, they also have an investing platform where you can buy and sell ETFs, individual stocks, and cryptocurrencies. And you can even automate your investing or speak to an advisor at no additional cost. I will say though, if you're a more sophisticated investor, Sofi in its current form might not be the best option for you because as of right now, they do not offer any options trading, as well as your cash just sits there earning no interest. Unlike Fidelity or Interactive Brokers, where the cash that you have on their platform can earn up to 2.5% right now just for holding it in cash. Now, they're currently hard at work at adding new features and products to their overall service, and have said that they're trying to implement options trading onto their investing platform before the end of the year. Now, the last segment of their business, which is probably the most well-known part, is their lending platform. And within their loan offerings, they tend to target a person with 730 or higher credit score, as well as an annual income of somewhere around $150,000. Now, as an investor in Sofi, this shows that you're more insulated from financial downturns and can weather the storm because the people who have loans with Sofi tend to be of a higher income bracket and are more creditworthy. Now that we've gone over all their product offerings, I can confidently say that if I was looking to get a new bank or looking for my first bank to set up a checking and savings account with, I'd probably choose Sofi because of their great benefits. Now, I'm not affiliated with Sofi and I have no connections to it whatsoever, but I do think that they have great benefits and can majorly disrupt the financial institutions that we currently have like Chase and Wells Fargo. In fact, when I was doing research on Sofi, I decided to transition a lot of my banking needs to Sofi because of all of their competitive rates. Now, I think most people can agree that Sofi's offerings and rates and services are far better than a lot of the traditional banking institutions like Bank of America and many others. But the real question is, should I invest my money into Sofi? Well, the stock has taken quite a tumble from about $25 at its peak to now sitting around $5 at its current price, and with a market cap of $3.9 billion. And at one point, it was under $5 per share, which would make it technically a penny stock. And it's important to note that because the management has enabled themselves to do a reverse stock split if it goes under $4 for a prolonged period of time. Because the NASDAQ requires companies to be above a certain price in order to be listed on their exchange. And now, a reverse stock split wouldn't mean anything necessarily to their fundamentals, but it could have a large psychological effect in the market and drop a sharp decrease in price. A lot of people also believe that if a company is doing a reverse stock split, it is really fatal for the company and it means they could be going bankrupt. But if you're paying attention to the fundamentals of the company, whether that's their profitability or revenue growth or user growth, that is a way better indicator than whether or not the company is artificially changing the price of their share. And another concern that a lot of people have with investing in SoFi is their share dilution. When they decided to acquire Technisys, they made a deal of primarily stock, which then diluted the shareholder of about 10% of their holdings. Now, while I think that the acquisition of Technisys was key to their strategic plan in the future, no shareholder likes to be diluted. And it's something to be aware of because your profits and your earnings as an investor will be split among more shares if they continue this dilution. Now, besides their share dilution, SoFi is currently at a very attractive valuation. With their user growth consistently growing over 69% for the past 8 quarters in a row, it shows that they have had great success with their marketing and ability to attract customers to their products. They have also seen a 48% increase year over year in Galileo accounts, which is also important for their business-to-business segment and continuing to grow that AWS of fintech business. Now, you may be concerned or hesitant to invest in a financial service company as Credit Suisse and Deutsche Bank are at great risk of going under, and with CDS spreads at a level that have not been seen since 2008, as well as other macroeconomic fears relating to Ukraine and supply chains and energy prices. But a reporter asked their CEO, Anthony Noto, how he thinks SoFi will be able to wear this current macroeconomic environment.
Right, and I know you've talked about the differences in your customer base. Anthony, you're still talking in terms of profitability in adjusted EBITDA, but the market and other CEOs have acknowledged that investors don't really want to hear that anymore. They want to look to positive free cash flow and net income profitability. Can you guys get there, especially if we're facing an economic slowdown? Should you be changing the way that you talk to investors?
We actually think the best value driver is free cash flow. And if you take our EBITDA and subtract our CapEx, that's the best measure of free cash flow. GAAP net income is not a full cash measurement, and that's why people are talking about free cash flow. And that's typically defined as operating cash flow less CapEx. But for a financial services company, because you're using your cash to fund your loans, we believe EBITDA less CapEx is a better measurement of cash flow because that drives increasing book value. Our book value today is $5.5 billion, and we'll continue to grow that because of that measurement.
Now, in this video, Anthony Noto says that he believes SoFi will continue to grow their book value in this time, creating value for shareholders. SoFi is a fast-moving company, introducing new products with fast-growing revenue every quarter. So I'm going to keep researching this company and try to keep you guys up to date on the newest things that are happening with SoFi. Thanks for watching this episode, and remember to do your own research and understand the risks of investing in SoFi. And if you like this video, please feel free to subscribe. If you have any questions, leave a comment down below.